Welcome back to another episode of Policy and Profits. I'm EJ Antoni. I like to play an economist on TV, but I'm joined by the one, the only trader extraordinaire, my good buddy, Anthony Esposito. Anthony, how are we doing this week?
EJ, doing well. How are you? By the way, thank you. Wednesday night, for everyone to know, EJ and I finally got together, had a delicious cocktail and a delicious steak. Got to chat a little bit and hang out in the DC area, which was great. Thank you, EJ. I had a great time. I appreciate it.
Hey,
It was
no,
worth
my
the
pleasure.
5 hour round trip on the train.
No, thank you. It was great of you to make the time. Although I will say I think the cocktails you make are a little better, but yeah, I might be biased. What can I say?
They are. But, when you pay $25 a pop, you gotta give them a little hat tip. So um, great night, great time. Great to be here with you again. Markets have been really crazy. A lot of
hmm
volatility just in the past 5 to 6 sessions. Um, but one thing that, before we get to the markets, one thing that's come up, which you have been out in front on for months, um, has been the reverse repo market and the Fed's activity. So I want to dive right into this and I want to pitch it right to you. Please explain, because the RRP chart that you have up on X and kind of your commentary is, it confuses me to some degree to understand exactly what they're doing, but it
hmm
is clearly a problem that most people are not talking about. This is the reverse repos that you built and posted in billions of dollars. Could you please explain what this is, why this is important?
Sure. And look, Anthony, you're not alone. The vast majority of people, it doesn't matter if you're talking average Joes, if you're talking money managers, even if you're talking people directly involved with Fed transactions, most people don't understand reverse repos because it's really counterintuitive. This is basically people lending money to the Fed, which sounds silly. Why on earth does the Fed need a loan? They have a money printer, right? They have a magical checking account where they can literally just pay for stuff from an account with a zero balance. So why on earth do they have this? The whole point of the reverse repo facility is to absorb liquidity. It's when there's too much liquidity out there and the Fed is trying to maintain a floor on interest rates. They're trying to prevent interest rates from going too low, in other words. And so to get rid of the liquidity out there that would allow interest rates to fall too low, the Fed basically says, hey, look, we'll loan you money at a certain rate. It's no risk, and there's really no term premium because these are short loans. So essentially this guarantees that rates are not going to drop below a certain level in the market. So you can see early on, I mean, these things spiked well over 2 trillion, I think 2.5 trillion, and that
Yeah.
speaks to just how big the balance sheet used to be. In other words, the Fed bought so many securities and put so much liquidity out there that
Uh-huh.
even when interest rates were only like a quarter of a percentage point, they were still having to absorb trillions of dollars of liquidity to basically prevent rates from going negative. Now, over time, as the Fed has sold off the balance sheet and put up rates, they haven't had to work nearly as hard to maintain those interest rate floors, right? So we've seen a lot of changes, in other words, in Fed policy over the last couple of years. But what this represents, this reverse repo facility, you can think of it as how oversized the balance sheet is. It's kind of a crude way of putting it, but if you, again, you can think of it as this is the amount of excess liquidity out there. And once that goes to zero, that means the Fed is no longer having to work to maintain an interest rate floor. Instead, we are now very, very quickly approaching the point, maybe just hours or days away, from when the Fed is going to have to start injecting liquidity in order to prevent rates from going too high. Instead of maintaining an interest rate floor, they're going to have to maintain an interest rate ceiling. And they do that with instead of reverse repos, with regular repos, or what we call repurchase agreements. This
So
is
let me
where, yeah,
I'm
sure,
going to
sure, go
pause
ahead.
you right there for 1 second. So the repurchase agreement is, just to dummy it down,
hmm
they are taking in securities, they're buying securities, and then obviously delivering cash for the securities. And that's the injection of liquidity that you're talking about when they repurchase. When they reverse repurchase, they're actually selling off the balance sheet, taking in cash, and reducing liquidity in the open market. Correct?
So the only thing, Anthony, to add there is that unlike regular open market operations, where if I'm the Fed and you're a bank and I sell you a bond and you give me the cash, right? That's how I take that cash out of the system.
Yeah.
In this case, it is because this is where you get repurchase from the security is then repurchased by the counterparty.
Got
So
it. Okay.
so this is, in other words, this all reverses the next day.
Got
And
it.
that's why it has to constantly be done day after day after day if the Fed wants
Okay.
to keep absorbing liquidity. And then likewise, if the Fed wants to inject liquidity with regular repurchase agreements. Now, again, we have to do this every single day because there is no permanency, if you will, the same way there is when the Fed turns around and buys something in the open market, right? I'm handing you cash, you're giving me a security, and then we're done. The transaction
Okay.
is not going to reverse the next day.
Okay. Okay. So where we are right now in this reverse repo chart is the Fed has essentially sold off everything they had, right? And that's been a period of quantitative tightening. Is
Yeah,
that correct?
yeah, exactly,
Okay.
exactly. That's a very good summary, Anthony. And so now, as the Fed continues that QT or that quantitative tightening, it's
Hmm.
very minor. They're selling off only a few $1 billion a month, which in the multi-trillion-dollar money markets is kind of a drop in the bucket. So we're moving at a snail's pace, but we're still moving. So as the Fed continues that quantitative tightening, we are basically now at the point where they no longer need to absorb any excess liquidity because there is none. Now they're going to have to start injecting some liquidity to prevent rates from going too high. And again, this is not a catastrophic move, at least not at the moment.
Yeah.
The Fed funds rate and the larger, I don't know if you want to say more comprehensive, but the broader overnight banking rate, that they're both at 4.11% right now, I think
Okay.
was the reading this morning. So, again, this is not they have not, in other words, they have not spiked outside the target range for the Fed funds rate,
Okay.
between 4 and 4.25. So it's not as if the Fed is struggling to maintain rates, Anthony, the way they did, back in September of 2019 when they had an actual repo crisis. And here's the important thing, that's where we're headed. The standing repo facility just got tapped for the first time in a very long time yesterday. It didn't need to be tapped this morning or overnight, I should say. But again, this is the direction we are headed in.
Okay. All right. And then you talk about so a little bit of a canary in the coal mine, a little warning flag as we
Mhm.
watch their activity in the reverse repo market. Um, you talk about levels and quantities. We have a second graphic up, which you kind of made a little joke out on the on X as far as is this the desk for ants? So again, the numbers here are small, but
hmm
we're excuse me, we're heading in the wrong direction. We're heading back towards that crisis type, or potentially that repo crisis scenario that we saw in 2019.
Right. Yeah, exactly. And we were actually on target for this to happen towards the end of last year. In fact, I think it was, I don't know, Anthony, maybe like March or April. I'd have to go back and check when we were talking about this on a much earlier episode. And it looked like this is the point we were going to be at towards the end of 2024. But because the Fed cut interest rates, that changed the whole dynamic, right? You don't have to, and they also changed the rate at which they were selling off the balance sheet, and so
Okay.
the struggle to maintain an interest rate floor, really changed, and there were a couple other tweaks to monetary policy, and then on top of that, one of the things that happened this year was the whole debt ceiling fight. And now we have the government being shut down. So all of these things have been different dynamics that have changed. For example, the rate at which the Treasury Department was having to auction off T-bills, and that
Okay.
changes the dynamics in the money market too. But whatever the case, although the timing clearly had changed because events changed, the dynamics that are at play here are literally exactly what we talked about, I mean, over a year ago.
Yeah. Yeah. This is interesting. All right. So pretty. This is interesting. This is something most people are not looking at, but definitely
hmm
something that needs to be paid attention to.
Right, right.
Um,
And
Thank you,
if
EJ.
and if I can say, Anthony,
Yeah.
the reason why we should be so focused on this, because a lot of people think this is still just all about monetary policy, like basic monetary policy. We're looking at the unemployment rate, we're looking at the inflation rate. That's not even Powell's primary concern. They talk all the time about their dual mandate, but
Yeah.
with Powell at the helm, the Fed is really primarily using all of its monetary tools for financial plumbing. They're just, they're so obsessed with this ample reserve regime that that's really what they're focused on today. And so we kind of have to view, I think, the financial impacts of this not in terms of monetary policy according to inflation rates and unemployment rates. No, you have to look at this in terms of monetary policy being used as little more than financial plumbing tools. And so this is where we come to the conclusions like, all right, the Fed's going to have to start injecting a lot more liquidity very, very soon. Not because of inflation, not because of unemployment, but simply because of how they view these monetary tools in terms of being used to tweak the financial plumbing, to keep plenty of liquidity flowing through the system.
It's really interesting to me. I just as a side note, and I'm hearing everything you're saying, but um, it seems to me where we keep continue, and for the past, I'll say 25 years, we've been on this path of really trying to manipulate markets,
Mm,
and create or direct the plumbing where we feel like, or the Fed feels like, or the Treasury feels like, or the government feels like they're actually bigger than the actual market and economy.
hmm
And it's
hmm
almost like you poke the bear long enough, and you get pretty confident that you're okay poking the bear until he wakes up. And then when he wakes up, you have a problem. And we seem to continue. I mean, you could look at a long-term chart of the S&P even just as a
hmm
gauge of the market, where we had a steady flow with some volatility. Obviously, you can go back to 29 and through the 60s and 70s, and you had some volatility,
hmm
obviously, in capital
hmm
markets. But for the most part, it was a contained growth until we started to hit 81 was probably the last great opportunity to buy it at truly low valuations. I would say that.
Yeah.
And then you hit the 90s and you start seeing these boom and bust, these massive spikes and these massive drop offs, whether they're shocks to
hmm
the system like a tariff conversation or COVID, or whether they're significant breaks in the structure in the system like the housing crisis, or bubbles like the tech bubble. Like, we have really started to create, and I think it's this has a lot to do with it, the manipulation of the system of capital of the markets
hmm
in
hmm
an upward direction. And you can't control this. You need to let the markets be as they are. And the more you manipulate, the more you may get that sugar high. But when it turns, it's going to turn more aggressively. And we're seeing that. We're seeing that in the boom and bust cycle, which I would say it would be extremely difficult, if not impossible, to come out of at this point because of how entangled and entrenched the Fed is and policymakers are. Do you agree with that? Or what's your take on that?
Oh no, Anthony, I think that's a beautiful articulation, 100%.
Oh,
And
thank you.
and as we continue to kind of, I mean, we're basically like financializing everything. It really started, like you were saying, after 81, we really started to financialize homes in this
Yeah.
country, not only because the interest rate manipulations juiced the housing market, because as you drop those rates, there's an inverse relationship there with home prices. So obviously, artificially low rates cause artificially high home prices. And now I
Yeah.
start to look at homes not just as a consumable, which is what they were for all of history before then, literally. But now I
Right.
start to look at homes as an investment. I mean, that's radically different, and
Yeah.
and it means that again now young people today they can't get into that very overpriced class of investments. And so
Yeah.
while it still is a consumable in some sense, the investment aspect of it means that the consumer part of it's just out of your reach. Good luck renting for the rest of your life. But
Yeah.
as time has gone on, like you were saying, through the 90s then, and then especially after the tech bubble into the early 2000s, the 2010s, and now where we are today, where we kind of have almost like an everything bubble, that financialization of all different kinds of assets has continued, and we continue to see that unfortunately play out today. And look, if you're lucky enough to be one of the folks who got in early in each of those bubbles, then you're doing okay because you're
Yeah.
seeing that asset price appreciation. But a- as we see these different technologies come online, things like AI, for example, that continues to benefit those sectors that have already been financialized, right?
Yeah.
But the things that you really, in a lot of ways, can't financialize, the things that people need, necessities like food, like rents, for example, right? I need
Mhm.
an apartment. At some point, I need somewhere to live. I need basic commodities like transportation, need a car. I just saw a report today, the for the first time ever, the average new car price in the US is over 50 grand. I mean, that's
Crazy.
insane. So,
Crazy.
I guess what I'm getting at here, Anthony, is the entire history that, 45-year history that you were just describing has created this kind of barbell distribution of the
Yeah.
haves and the have-nots in this country. For the first time, the whole talking point that a lot of people like to use of a certain political persuasion where they talk about the haves and the have-nots, that's really becoming a reality. It's not because of
Yeah.
capitalism, it's not because of free markets, it's because
Yeah.
of the manipulation of markets instead, particularly in this case, financial markets.
Yeah. Yeah. That's really interesting. I think it flows well into the policy, the profit side of the conversation today, where we talk
Hmm.
about these boom and these busts. We talk about a market that is, I don't want to say manipulated in a way where we start to, lean towards a criminal or nefarious conversation, but the markets are manipulated. There's no question. The markets are overly complicated. Um,
Hmm.
so if we look at the markets in general, part of the strategy here and part of the value in the strategy here is that, and I was talking to one of my clients out west, out in Utah yesterday, and he was asking me, no, explain further, like broad stroke, 10 seconds, like what's the value add in your strategy, and without getting technical, I said to him, the value add is there's a large swath of Wall Street that looks at up moves as opportunity and down moves as the time to have insurance and take shelter.
Hmm. Hmm.
I view everything as opportunity, and that's really the difference. I only see opportunity on the screen. The strategy is designed and functions on a top down technical basis to make money both up and down. The down moves for us are not let's outperform the market by hedging and losing less. The down moves
Hmm.
for us are actually better opportunities. We actually perform better in some cases when we enter a high vol bear regime versus a low vol bull regime. We execute better because of how aggressive the moves are. And if we're in early, which the strategy does a good job of doing, and I'm speaking specifically about 1/5 of the strategy here, or 2/5, which is the S&P and the Russell, so U.S.
Hmm.
equity exposure.
Hmm. Hmm.
Um, those returns on a monthly or quarterly basis become really outsized because of how aggressive the moves get. So with that, I want to look at the last two signals, which I've highlighted on this chart for the ACAP process in the front month generic E-mini futures, which is how I run the strategy. I run the strategy obviously on the active contract because I need to trade it. This is a generic rolled future, so we're kind of connecting the dots on price, and we
Hmm.
eliminate gaps in price from one contract to another contract. We can not go into term structure so much now and the role of contracts, but so this is the S&P 500 futures. On September 10th, we got a positive signal. The close on September 10th was 65.94, so I marked that up on the close, which is where I mark my signal each day. And the return there, we flipped negative out on October 9th. So on October 9th, we had a close of, let's see, we closed there at 67.79. So that was a return on that signal in the future space just for the S&P of 2.8%, which was a great trade.
Hmm.
Um, it was a little, I'll admit, a little white knuckle going through it, which is part of the value of the quant and the rules that I have in place,
Hmm.
where sometimes I would by gut say I really don't want to be long here or I think I should be short here. But the 29 years of experience in trading, very valuable, but the rule set and the quant that I've built, extremely valuable. So I
Hmm.
have the
Hmm.
model in place. I haven't forgotten that I have gray matter between my ears. Some people would say not too much, but I have some gray matter between my
More
ears.
than
So I'm
most.
working
More
on this
than
model.
most.
Um, so we have a 2.8% return to the upside. And this isn't just a touting of signals. This is kind of the model, the quant itself, and then how I'm looking at the world recently. We did get a negative tick on the close for the signal on October 9th, which is pretty interesting. So at 67.79, futures close on the 9th. And then we know that was Thursday. On the 10th, which was Friday, we actually had a drawdown from that closing print to the low of 3.5%. So
Hmm.
that
Hmm.
became a really interesting trade and a very profitable day. Again, a spike involved. We've seen VIX go from about 14 to almost 30 now in the past 6 sessions. So
Hmm.
almost a double in VIX. That's another conversation. But we saw a really great trade down in the S&Ps, and we were able to take advantage of that. I have been out in the report. So this is model, right? This is quant and rule based. These are the trades. Got the negative signal, got the positive signal into the negative signal, and that was the move. We don't always go negative straight to positive or positive straight to negative. We do have a neutral signal where the model's just letting the dust settle, and I haven't gotten all of my momentum trend indicators to match up and line up in order to get a signal.
Hmm.
In this case, we did get a straight flip. So as we get this flip to negative on the 9th, which kind of surprised me because I thought we were still in that point, in that spot position to move higher through towards 6,900, 7,000 for year end, which we may still do. But at that point, I didn't see this coming. This was obviously a headline move down off of a conversation with President Trump and tariffs. But
Hmm.
that said,
The
this
headlines are interchangeable, right?
the headlines are interchangeable. There is no question, and I say that a lot because the day before I had a lineup in my indicators to get negative. I had no idea what was going to come out on Friday, obviously, but momentum and trend had all lined up, shifted down, and then in comparison to price, marked up at a negative signal in the model. So interesting how that happens. I'm just saying.
Hmm.
Um, Now, when I came out, and this is important now, so now we start to think a little bit as we're within the model. And normally on balance, I let the model signals run.
Hmm.
I may reduce exposure if we're full boat in long S and Ps, and we're hitting levels where I kind of see something change here. I see peripheral models starting to tick down. I may reduce exposure, but typically I am in on the positives long. I am in on the negatives short, and
Hmm.
over time that return has been fantastic. Um, Not always positive, obviously, but the returns have been fantastic.
Hmm.
What I found interesting was we actually traveled the entire Bollinger Band. So we were essentially at the upper band on the 9th and then sliced well below the lower band on the 10th. Not typical action. So extremely volatile, extremely manic selling.
Hmm.
Um, could kind of expect that as everyone's starting to talk about, which I love when the talking heads start to talk about, valuations, and there may be some air that needs to come out of this Mag 7 AI bubble. That kind of cracks me up. But we traveled the entire channel, which was extremely concerning to me. However, we closed right on the 50-day, right?
Okay.
So the closing print here came in at 65.95. And then I just noticed as I was doing my analysis that and this is totally coincidence, but I do like when things line up. So coincidence, but valuable. The close back on September 10th, when I got the original buy signal or the previous signal, which was a buy,
Hmm.
was 65.9450. So we were within zero point 0.5, 50 cents of the close between the buy signal close and that massive drawdown close on the 10th. For me, that was interesting enough to say we've held the 50. This was a headline,
Hmm.
massive move down, a very good return on a one-day trade on the short for the S&P, and obviously the Russell we were positioned the same way. Um, at that point, I had said in the reporting, this is a negative signal. I'm using my rule base now. So I have the quant skeleton, and then I have a rule wrap, which is my alpha add. What do we do with that rule base within parameters of the rule set? Um, I was saying I would not be short. I would cover that short. I would personally cover that short in the portfolio, and I would be sitting flat waiting for a better signal with the expectation that the 50-day would be support. Okay. So I leave it there for the next couple of days, and this chart actually ends on the 15th. So we had yesterday and then today ticking live on the chart. But on as of the 15th, I was still saying I would not be short above the 50-day.
Mm,
So for me,
okay.
the way I would get short, to say it another way, would be still a negative signal, ACAP signal still negative, and we break the 50-day, I would then be getting short. But above the 50-day and negative, I'm neutral. Above the 50-day, if we get a shift to positive, I would be long. That changed on the 16th yesterday, and this is really important as far as the process as well. We remain neutral with the ACAP signal in the S&P 500, the E-minis.
Hmm.
That's
Hmm.
that. We remain below the middle of the Bollinger Band, that 20-day moving average. That's interesting to me. We're still above that 50-day. However, two of the peripheral models that I have are the VIX. I have a VIX spike model where I count kind of highs and lows and day counts, and I get to a spot where we're either risk on, risk off, or neutral.
Hmm.
That model spiked hard repeatedly into risk off. And then I saw my VIX term structure model, which again is now the VIX curve, and I'm actually measuring the kind of the action and the slope between spot VIX front month and second month.
Mm,
That actually has been risk on for 2 months. That shifted to risk off. So I have both of my peripheral VIX models shift to risk off for equities. I have equities struggling to break out through the top of the upper end of the Bollinger Band, um, holding the 50-day, but kind of potentially getting squeezed. So last night, as I wrote my report, the futures were reopening, which is today's stick because we're in the overnight into the cash session. I did shift from an ACAP negative signal, B flat, B away for now, not short above the 50-day, to I would be short this signal. Now,
mm,
there was a massive move down. And for those of you following the market, we were down about 2% in the overnight,
hmm. Hmm.
which we've now rallied all the way back from. So overnight session, we hit a low of about 65.70. We then rallied into the cash session up to 6,700. So what I'm saying is, for me personally here at Ascalon 6, I watched a very nice, again, overnight profit in futures get erased as we headed into the cash session. I'm sticking to that signal. I'm sticking to that short signal, as is my way. Um, I do see potential here for more of a move lower in the near term. I
Hmm.
don't know how this signal ultimately flattens out to neutral or positive again, but I do see reason between the ACAP signal being negative and the peripheral VIX models really flashing pretty hot warning signs to me right now. I am short, even though we're above the 50-day, and I do expect, on balance here, a breakdown back below 6,600, potentially down to the 62, 6,300 level in the near term. And then at that point, we'll see what the model's doing and what action looks like. But just as a breakdown here, I thought it would be valuable to talk about the market and where we are, where I think we're going, obviously, and then to show the last two signals and what those returns look like, and
Hmm.
also how I'm combining the quant and the rule wrap with technical analysis and peripheral models to work within that rule set in a way where we're taking full advantage of the quant, but then adding that alpha based on those peripheral models and the technical analysis. So that's kind
Hmm.
of where we
Hmm.
sit here. On balance, ACAP signal is negative. You can see it out on X at CMT_Anthony. You can go to Ascalon6capital.com and subscribe to the morning note, which is free, and see kind of where I think we're going and where we are. But that's the scenario right now. That's a good breakdown, I think, I hope, of the quant model, the alpha ed rule wrap, and where we are right now over the past 6 weeks.
That's a fabulous breakdown, and it's a great illustration of why I trust you with my money.
Thank you.
Because it's a successful model. And I'm so glad, Anthony, that you led with the fact that this is about making money on the way up and the way down,
Right.
right? This is not simply, the old-timey buy and hold. That doesn't work anymore. It genuinely doesn't. And I understand if you bought the S&P, 50 years ago, obviously it's way up. But you know what else is way up is gold. And if you think of
Mhm.
gold as your real inflation indicator, in other words, instead of the price of gold in dollars, think of the price of dollars in gold and consider that to be the real rate at which the dollar is being devalued. In that case, you've actually lost money. In
Yes.
other words, the S&P relative to gold has been down over the last half century, right? And now
Correct.
with the last few weeks or months of gold moves, it's pretty significant, right? It's not even close. So
Yeah.
this whole idea that you can just buy and hold, and every time there's a dip, you just got to ride it out. Again, it's not enough anymore. And I think if those are the kinds of strategies that your money manager is handing you, it's weak, frankly. I think it's just weak, and you need
Yeah.
something better.
Yeah. No, I agree. I agree. Like I said, opportunity across the board. The portfolio here, the way I run it is distilled down to 5 assets, all in the future space. And I run them according to the model. We run them, based on that quant and that rule set.
Hmm.
And it's been productive. It's been productive, and I'm confident that it will continue to be. But opportunity up, opportunity down. You can't be along just for the ride. There's a portion of
Yeah.
your investments that should be long only, buy and hold, collect your dividends, clip your coupons. That's absolutely fine. I have no problem with that at all. But there is a place for an alternative strategy like Ascalon 6 in every portfolio where you're not
Hmm.
hiding when things get bad. You're actually feeding. You're actually making money. So
Yeah.
that's kind of the point, and that's how we function here, and that's our goal, and that's how it's worked out, which has been really good. Um, EJ, appreciate the time. That the reverse repo data and analysis is really beyond. It's beyond the scope for me. I do quasi understand it. I definitely need to dig in a little bit more on it. But your explanation of it, you're bringing it to light, is greatly appreciated and very important because people are not talking about it. And this is one of the things when you look back. Um, in 6 months or a year from now, you say, oh, how did we not talk about that
Yeah.
as a potential issue for the market?
Hmm.
So
Hmm.
that's kind of the goal here. And that was a great conversation, great breakdown. Thank you so much for being here. I appreciate it. Great episode again of Policy and Profits. Um, I will hopefully, well, I won't see you next week, but hopefully in the next few weeks we'll grab dinner again and
Would
we'll
love
go
it.
from there, my friend.
Sounds good. Anthony, have a great week.
Thank you, sir. You too. Enjoy the weekend, and I'll talk to you soon.
Till then.
Bye.